So first, what is the problem? What are the challenges? The challenges that we face are the fact that the markets and the regulations are always changing, okay? And this, amongst other things, can lead to overwhelm, to confusion. Also, we don't have time. We don't have time to learn all these things, all the different strategies to follow the markets, to do all this. And we also lack focus. We lack clarity. Sometimes we lack finance or capital, or sometimes we have the money, but we think we need a lot more than we have. So sometimes we actually do have it, but we just don't think we have it, you know. Um, we also lack knowledge. We also sometimes have fear, and sometimes we invest and then we make very small gains, 3%, 5%, 10%. Yet the risk that we are going through to make those small gains is big. You might invest a lot of money and just get a small percentage, but if you lose a lot of it, right? And then also waiting a long time to reach profitability. And sometimes we make gains and then they're wiped out by unpredictable events. They're called black swan events, or just normal movements that we never thought would happen. Then we have difficulty knowing what to invest in. Even if we may have all these other things: time, focus, clarity, money, but then we just don't know what to invest in. And even if we knew, we don't know when to buy and when to sell. It's called market timing. Nobody can time the market, and we all want to, we all wish to, but even the biggest investors, such as Warren Buffett, will say, forget about timing the market. It just doesn't happen. It could happen by pure luck, and but that same luck may end up crushing you. So, knowing when to buy and when to sell is a very big problem. So, what kind of solution would work for us while eliminating all these challenges? Is it possible? Yes, it is. Okay. And now we're going to get into the steps that we mentioned, the 4 steps. The first step is called asset allocation. This is a very simple thing because it simply means choosing the ingredients or the assets that are going to go into your portfolio. Okay? This is something that is done only once a year or once every 5 years or whatever, once every 2 years. It's not something you do every day. You don't wake up every day and read the newspaper or whatever and then decide what to invest in. Okay? You allocate your assets once. It's a long-term decision, and then you lock it in. And this eliminates the following challenges: difficulty knowing what to invest in, overwhelm and confusion, changing markets and regulations, lack of focus and clarity, and fear. Imagine if I could show you a way to choose your assets once, and very few assets. There are thousands and thousands of shares, and then there are tons of bonds out there. There are tons of different investment opportunities. What if there was a way that you could simply choose once a year 5 things to invest in, or 4 things only, and that's it? Then you don't have to make that decision ever again. Wouldn't that eliminate all these different challenges? It would, right? By the way, as we proceed, you'll notice that there's always that little badge, the law of attraction, thoughts becomes things badge. And this is to keep you aware that although we are talking of decisions, behaviors, thoughts, actions to take, at the background, the law of attraction is always at work, okay? So I just want to let you know that, it's not that we're doing without it. It's always working in the background. So just think of it that way. Now, the reason why we practice this thing called asset allocation, or or choosing different kinds of assets, and I'll show you which different kinds of assets to choose, is because we recognize, for example, for one thing, that different kinds of assets move in different ways. So if you take an example of stocks and bonds, usually they work in reverse. When stocks are up, bonds are down. When bonds are down, stocks are up. So although you may not know when the stock will go up or the stock market will go up or down, or you may not know when the bonds market will go up or down, if you, let's say, hypothetically invest in both equally, 50-50, then it doesn't matter, because when one goes up, the other one goes down. Okay, I know that sounds like a zero-sum game at the moment. It sounds like, well, wouldn't the gains of one cancel although the gains of one cancel the losses of the other, doesn't that mean I'm always at the same place I always was? Yeah, hang on a second, we'll address that in another step. The point for this step to keep in mind is that since we cannot time markets, we can at least know that markets quite often behave in opposite ways. And this is one of the keys to solving the puzzle of investing profitably without stress. Okay? Another example, quite often the real estate market works opposite to the stock market. When the stock market is up, the real estate market is down, and vice versa. Another example, the gold market works opposite to the dollar market. When the dollar is down, gold is up, and vice versa. Okay? The Bitcoin market quite often works opposite to the gold market. You see, when one is down. So this is a very important piece of market behavior that will help us going forward, okay? So for now, don't worry about how to use it, just keep it in mind. Now, having considered what we just saw about the markets going up and down in opposite ways, we can now understand that the kind of assets we need to pick need to sort of take advantage of this behavior of working in opposite ways, okay? So, when you're sitting down at the beginning of the year, once a year, to decide what assets you're going to invest in throughout the rest of the year or throughout the rest of the next 2 years or 5 years or whatever, you're going to make a portfolio that comprises of things that move in different ways. In other words, when one is risky, when it's time for one to behave in a way that is sort of risky, the other one is sort of behaving in a safe way. Or when one is up, the other one is down. So this kind of counterflow is very important, and you need to pick things that move differently. So you do not want, for example, to only invest in shares and ignore everything else, because that means when the stock market is down, everything of yours will be wiped out. Or you don't want to just stick with cash, or you don't want to just only stick with bonds, or only with gold, or only with one thing, because then you kind of get trapped. When it goes down, it goes down. If you only invest in real estate when the market is down for real estate, you're screwed. You don't have anything else going for you, you see? So your portfolio needs to kind of like represent those things. Now, specifically, this is a portfolio that I suggest for you, and this portfolio comprises, don't worry about the percentages. These are for now I just put in random percentages, right? So don't take the percentages to be religion, okay? What I need you to look at is the kinds of assets that are listed over here. Let's start with the simplest, cash. You don't need so much cash. You just need to keep cash enough for your daily use for maybe the next 1 month or 2 months, or maybe max 3 months. Why do you need more cash than that? If you're not going to use it, why keep it in the bank? It loses value every day. Inflation eats your money, the purchasing power of your money every single day. So you don't need to keep it as cash. So you just need a little bit to cover your expenses for the next 1 month or 2 months max, maybe 3, depending on how much money you earn. So not much cash. And then the next thing, index funds. Index funds are most of us know what mutual funds are, right? Unit trusts, they're also called. Mutual funds are funds that invest in the share market, so that when you put in $100 in a mutual fund, that $100 is going into a whole bunch of different shares, and the fund management, the people running the fund, are the ones who determine where your money is going to go, okay? Now, that's a mutual or a unit trust fund, okay? That's not what we're talking about. We're talking about index fund. Index funds say, get rid of the manager. Instead, what we're going to do is take your money and spread it across all the shares in the market that comprise an index. So, for example, if you're looking at the NASDAQ index or the Dow Jones index or the Nikkei index or whatever, the ASX index, your money is spread throughout all the shares that comprise of that index in the volume that they comprise. For example, a big company like Apple will take more of your money than a tiny little company that is not known that well. And the thing about this is that the idea is that even though individual companies may go up and down, as a whole, long term, the market will rise, okay? So the index fund gets rid of the guesswork and just says, look, I'm just not going to try and be the superhero and guess which company is going to do great. I'm just going to spread my money across the economy. That's what an index fund is. Silver and gold are obvious because when things, let's put it like this, when shit hits the fan, either the economy goes bad or the currency goes bad or whatever, everybody runs to gold and silver because they are better than currency. Gold is not just an investment, it's actual money. If the US dollar or the euro or any other currency got wiped out and you had gold, you can still go and exchange your gold for something. Gold is super valuable. In fact, it gets more valuable when there is trouble. When there is chaos, gold becomes more valuable. So you need quite a bit in gold, and you don't have to buy gold in big amounts. You can have, like a GSM SIM card. It's so tiny, right? You can have that tiny amount of gold, okay? And so you actually, it's not just for the rich and famous. You can have even jewelry. Jewelry is gold. You've seen people who wear jewelry. If they had to, they can pawn that off into cash. So, think of it that way. Then my favorite ones are the new cryptocurrencies such as Bitcoin and Ethereum. These have been growing by leaps and bounds. Sometimes, 30% in a month, sometimes 100%, sometimes 300% in a month. And these are the new money. And we'll talk about that in challenge number 5. And you'll get to understand why they're not just here for a short term, why they're not just a joke, okay? Cool. But now, just to quickly mention, look at these charts. This is Bitcoin. It moved in the last 10 months from $445 per Bitcoin to $1,199 in 1 year. Look at that gain, okay? Just calculate what percentage that is. It's ridiculously good, right? And then in the last 1 year, Ethereum did even better, from $9.66 to $48.57 in the last 12 months. That is several hundred percentage points, right? Up. Cool. Now, the second step, we saw the first step was asset allocation, choosing your assets once a year or something, and deciding what your portfolio is going to look like, and then you stick with it. You don't change it every day. So if you decided your portfolio is going to be, where were we? Over here. Let's say you decided that's your percentage. That's what your portfolio is going to be like. You're going to invest in those percentages. Just an example. You're going to stick with this for the next 1 year. You're not going to move it. You're not going to change it. Okay? Cool. So then once you've done that step, second step is called dollar cost averaging. This is where you invest a fixed amount of money regularly into your asset allocation plan, the plan you just made. We just saw the pie chart, right? And you do that, let's say every week or every 2 weeks or every month. You have to choose, and once you choose, you stick with it. And you do that regardless of what the price is, regardless of what the news is, regardless. Like after that, once you've made your asset allocation plan, you don't care anymore. You don't care about price, whatever. If you've decided you're going to invest $100 every week, and you're going to spread those $100, let's say $20 to Bitcoin, $10 to gold, whatever, you'll do that every week, regardless of price, regardless of news, regardless of whatever. Doesn't matter. The worst thing happens, you still carry on with your plan. And I'll show you why that works in a short while. But this eliminates the overwhelming confusion. It eliminates lack of time, lack of focus and clarity. It eliminates lack of money and finance. Because as you can see, you can just put in $100 every week or $50 every week or whatever, right? It eliminates the challenge of lack of knowledge. It eliminates the fear factor, because it doesn't matter what the market is telling you. You still just follow the plan. And by the way, in a way that you're about to see, it also eliminates the risk of your gains being wiped out by unpredictable events. In fact, unpredictable events will actually help you gain more, okay? And also it eliminates the need for you to know when to buy or when to sell. Now that you don't need to time the market, okay? Now, this is an example of dollar cost averaging. Let's say you've decided every month you put in $100. So you'll invest April, May, and June, you'll put in $100 each. And let's say you're buying, just for the simplest example, let's say you're buying shares only. And in April, the price per share is $10. In May, it went up to $15. In June, it went down to $13. Now, you did not care what the price was. You simply put in $100 into this share. And that means in April, you got 10 shares out of your $100. $100 divided by $10 means 10 shares. In May, because the price went up, your $100 bought you 6.7 shares. In June, because the price went down from 15 to 13, you got 7.7 shares. Now look at the total down there. In total, you invested $300, right? Now, out of those $300, you got 24.4 shares. When you work that out, that means your average cost per share using this strategy was $12.32 per share. You take $300, divide by 24.4, you'll get 12.32. However, if you just simply take the average price per share over those 3 months, you add 10 to 15 to 13, divide by 3, you'll get 12.67. So dollar cost averaging in this case has actually allowed you, without any effort, to buy below the average price. Do you see? Because when the shares are cheap, you get more shares. When they're expensive, you get less. This mathematics behind the scenes allows you to buy below the total highest and often even below the average. Okay? Can you see that? Now, if you look at it sort of like on a more long-term scale like this, and you graph it, you'll notice that every time the share price is high, you get less shares. Every time the share price is low, you get more shares. And this is what helps you counter market movements, because when it's cheap, you're getting a lot. When it's expensive, you're getting a few. And you'll see how that works, especially when you throw in the third step, okay? Which is, third step, rebalancing, okay? Rebalancing, by definition, means, first let's look at the frequency. How often do you rebalance? You do it quarterly, meaning after 3 months, every 3 months. Or you can decide semi-annually, means after every 6 months. Excuse me. So every 6 months, or maybe every 3 months, you rebalance. If you're really dealing in something volatile, you can rebalance every month, but it's highly unadvisable. Better stick to quarterly or semi-annually, okay? And you don't want to stay too long. You don't want to do it every year. Okay, so now what do you do every quarterly or every half year? You buy and sell the assets in your portfolio to maintain the originally set level of asset allocation. Remember when we were doing step number 1, asset allocation, and we had our pie chart? Because of the different movements in the market over time, your pie chart will move. The distribution will move. It will change from what it was. You know, some things will go up in value, some things will drop. So you'll notice that your distribution has changed. So what you do is you buy and sell to come back to the original. And I'll talk about how in a sec. First, let's understand what this does. This eliminates the challenge of overwhelm and confusion. You know what to do. It eliminates the problem of lack of time, okay? Lack of focus and clarity, lack of knowledge. And as you'll see, it eliminates the problem of making small gains from big risks. You don't have to wait long time for profitability. Your gains are not wiped out by unpredictable events. In fact, the unpredictable events help you. And it also eliminates the difficulty of knowing when to buy and when to sell, market timing, okay? Let's see how. So this is the same chart we had earlier, the before chart, as you can see. And then after 6 months or after 3 months, whatever, this is the chart after. You know, we find that, for example, Ethereum 3 months ago was maybe cheap, and now after 3 months, it's risen up in value. So although we invested the same amount of money in Ethereum every month, the price action of Ethereum itself, the market value has gone up. So although maybe we put in $20 a month in Ethereum every month, maybe the Ethereum price in the first month was, let's say, $10. And then in the third month, if the price had gone up to $40. So the shares we bought earlier on in the first month have all gone up to $40 today, right? So, and then maybe gold has gone down in value. Maybe Bitcoin has gone up in value. Maybe, you understand? Whatever. So this has changed the composition of our chart. The before and after chart now look different. And what we want to do is actually sell the things that have become too much and use that money to buy the things that have become too little. That is called rebalancing. We're not going to use that money to buy new clothes or to take a holiday. We're going to reinvest. Okay? And this is what we're going to do. We're going to buy, sell, and reinvest. Buy what was too much and use that money, the gains, to buy what is now cheap today, what is too little. What does that mean? That means, again, you don't sell and buy clothes or buy, other things. You literally use the gains to reinvest, okay? And that's the key. If you use the money to buy nonsense or whatever it is, or to take a holiday. A holiday is not nonsense, it's good, but still, if you use it to take a holiday, you've broken the system. You must reinvest the money. But what does this mean? It means, let's say, Bitcoin and Ethereum rose in value and gold fell. When you sell the excess Bitcoin and Ethereum and get that money and use it to buy gold because gold fell, and buy silver because silver fell relatively, and whatever, buy index funds, it means today you're using what has appreciated value, you're selling it, meaning you're recapturing the gains before they're wiped out, and you're using those gains to buy what is cheap today. You see? So Ethereum and gold and Bitcoin has helped you buy gold for free, for out of thin air, because maybe in the next cycle, gold is on that's going to go up, you see, and maybe Ethereum will go down. So you're not going to lose those gains. You'll have captured them during the rebalancing event, and you'll have used those gains to buy what is cheap. You see? So you don't have to think about market timing. Rebalancing automatically does it for you. So the reset event is very important. Cool. The fourth step is actually the easiest because it actually involves you doing nothing. Compounding. Compounding, the definition is giving time for your children to have grandchildren and their grandchildren to have great-grandchildren. What this means in terms of money is allowing your money to give birth to more money, and those children money, to give birth to their own children down into several generations. It simply means you just set and forget. You don't eat your gains, you reinvest your gains. And this eliminates the challenge of lack of finance or capital and making small gains from big risks. And this is a chart that shows what $1, just $1, does over time. As you can see, compounded interest, when you reinvest the gains, at the beginning they start off very small. Even if it doesn't matter what percentage gain it is, 2% or 10%, the beginning is so slow. Because imagine, what is 10% of $1? It's just 10 cents. What is 2% of $1? It's even less. But 10 cents, next time when you add 10% of 10 cents is 1 cent, right? I mean, when you take the 10 cents, and you add them to the dollar, now you have $1.10. 10% of $1.10 is 11 cents. So you add them up, you'll get $1.21, 10% of which is 12 cents. And you add them up, you see. So compounding grows slowly initially, and then it just starts to zoom up. It just starts to increase. So the longer you leave your investment, the faster it just starts to take off, especially when it has a high growth rate. That is the compounding power of time. It's a superpower. And you don't have to do anything rather except reinvest your gains. Don't eat your gains, just reinvest them. Okay?